Hello, everybody. I hope everybody is doing well. My name is Lukman Rafiq, and I shall be the tutor for this webinar for the paper AFM Advanced Financial Management. I'm going to share a brief background about myself. I have been in teaching profession for the last 10 years now, and I have been conducting this webinar for the paper P4 for the ACCA. It's my fourth time that I shall be conducting this webinar. So the previous webinar that I conducted was for the September 2000 and for the December 2018 exam session. Before that, I conducted the webinar for the June 2018, and I also conducted the AFM webinar for the March 2018 examination. The webinar sessions, the question-based revision sessions by ACCA is an excellent initiative for a lot of students who actually fail to get a proper revision opportunity. And I'm going to actually consider, based on my experience from the past, that what the students' expectations are generally. So I am actually going to consider all those things that the students they generally want us to cater to. So that's what I would actually try and inshallah ensure that they are actually being done, catered in this specific session. So this is actually going to be a 4-day session with each session lasting for 2.5 hours. And I'm actually going to share the areas that I'm going to be discussing. If you could go to the handout section on this webinar window, so you will be able to download the exam questions that I shall be using for this specific session. So my areas that I would actually be focusing upon would actually include the risk management, and my focus is actually going to be more on the currency risk management. So I believe that the currency risk management seems to be a more important topic for the current session. So I'm actually going to be going through the risk management, and my major focus is going to be currency risk management. The other thing that I would actually want to share with you is that the other topic that I'm going to share, that I'm going to discuss in this specific webinar session, is going to be some areas of the investment appraisal. So we would actually be discussing few of the areas of the investment appraisal, and the majorly areas that I shall be focusing upon would include the APV, would include the risk and uncertainty techniques, etc., etc. So that is also something of an area that I shall be discussing about. Furthermore, I would be covering the mergers and acquisitions. I shall be covering mergers and acquisition also. And in addition to this mergers and acquisition, my other focus is also going to be on the restructuring aspect. So I shall be conducting the restructuring aspect also. And then there is this another important area, which is the dividend policy. So I would inshallah be covering this dividend policy also. So these are the areas that I would be majorly focusing upon. And we would try to attempt maximum questions pertaining to these specific areas. Now, one thing that I would actually want you people to understand is that, as I mentioned, that I have conducted 3 more webinars for this specific subject for ACCA. So what I would try is I would try not to repeat the questions that I have done in the previous webinars, so that in case if you want to access more questions, you can go on and you can log on to the ACCA's resource directory, and you can access more and more questions also. So I would try and attempt almost all of them being the new questions which we have never discussed before. Anyways, so let's actually start off. I think everybody can access the handout section. So let's just start off. We are going to start off with this specific question, which is a March-June 2018 exam question. And the question is about the currency risk, netting, and the transfer price. So the name of the question is this. Adverine Group. It says Adverine Group is a multinational group of companies with its headquarters in Switzerland. The requirement to this specific questions include various requirements. There are three requirements. One of them is a 9-mark requirement, the other is 7-mark, 3-mark, and then there is a 6-mark requirement. So basically, this is a question that covers various aspects of the currency risk management. What I would suggest is you people go through this specific question, read this question for 5 minutes, and then we shall start discussing. Okay, let's actually start off. So it says Adverine Group is a multinational group of companies with its headquarters in Switzerland. The Adverine Group consists of a number of fully owned subsidiaries and Ltd company and associate company based in the USA, in which Adverine owns 30% of the ordinary share capital. It says balances owing between the parent, Adverine, and its subsidiaries and between subsidiaries are settled by multilateral netting. The transactions between the parent and LTD are settled separately. So the transactions between parent and LTD are settled separately. So what are we being told? We are being told advise Adverine company on and recommend appropriate hedging strategy. For the US dollar cash flow, it is due to receive from or pay to LTD company. So what do we need to do? We need to talk about the cash flows that are expected to be received or that are expected to be paid to LTD company. So we need to have the appropriate hedging strategy for that. Now let's just discuss. If I talk about this, so we are being told that Adverine wishes to hedge transactions with LTD which are due to be settled in 4 months' time in US dollar. So basically, if I talk about this question, um, which is actually the March June 2018 question, March June 2018 exam question. We are being told that the transaction are expected to be settled in 4 months' time. What does it say? The transaction is expected to be settled in 4 months' time in US dollars. Adverine will owe LTD 3.7 million for a major purchase of supplies, and LTD will owe Adverine US dollar 10.15 million for non-current asset. So that means what do we need to do? We actually are expected to have a receipt of 10.5 million and we are expected to make a payment of 3.7 million. Resultingly, if we say we are expected to have a net receipt of 6.45 million, of 6.45 million in this specific scenario. So if we talk about this case, it says you are expected to receive this 10.15 and you are expected to pay 3.7. All transactions are expected to take place in 4 months' time. Now, what else is there? It says the group's treasury department is considering whether to use money markets or exchange traded currency future for hedging. So they are actually confused that what to use, how to hedge this. Should they hedge it using the money market or should they hedge it using the currency future? Now, it says the annual interest rate available are as follows. Investing rate is given, the borrowing rate is given. It's Switzerland, it's USA. The exchange traded currency futures, it says the contract size CHF 125,000 is basically CHF is the name for the Swiss franc. The price quotation is USD per CHF, 3-month expiry and 6 months expiry. We need to see if we are being given any other information or not. So apparently, yes, we are not given any further information. And all that we have to do is that we have to play with the information that is available on this specific section only. So this is actually how it is. Now let's talk. So we have got the relevant information from the question, which is like this. First of all, I'm actually going to talk about the money market, that how does money market hedge operates. When we talk about the money market hedge operates like this. You borrow in one currency, and you deposit in another currency. You deposit in another currency. Now, whenever you are expected to have receipt, in a money market hedge. So for the receipt, the hedge strategy should be formulated like this. The hedge strategy for the money market hedge should actually be like this, which is the foreign currency receipts should be used to repay foreign currency loan. Now, what exactly do you mean by this? As I mentioned that you have to borrow in one currency and you have to deposit in another currency. That's how the money market hedge actually operates. So in this specific situation, we are expected to have a US dollar receipt. We are expected to have a US dollar receipt. Our currency is the Swiss franc. So the hedging strategy for receipt is that if you are expected to receive the foreign currency, then you should create a foreign currency loan. That means you should create a USD loan. So what exactly is going to be the approach of solving this specific scenario? First of all, you need to establish the present value of foreign currency to be borrowed. Now, what exactly do you mean by present value of foreign currency to be borrowed? You see, first of all, we need to borrow USD. We need to borrow USD. The amount of USD should be such that the loan amount plus the interest on it should actually equal the repayment amount. The loan amount plus the interest on it should actually equal the repayment, should actually equal the repayment or the receipt amount. So what are we going to do? We're going to say that we are expected to receive a net 6.45 million. We expected to receive net 6.45 million. And if we can borrow dollars, so the interest rate which is applicable is 3.7%. If we can borrow dollars, then the interest rate that are available is 3.7%. So resultingly, what is actually going to happen is the amount to be borrowed is going to be equivalent to 6.45 million multiplied by 1 upon 1 plus 3.7%, 1 plus 3.7%, and this is actually going to be power 4 upon 12. So the amount to be borrowed is going to be 6.45 million multiplied by 1 upon 1 plus 3.7%, power 4 upon 12. So can somebody please confirm the amount of borrowing? Okay, there is a question that why is it 4 upon 12? So it's 4 upon 12 because you need to actually you need to hedge yourself for 4 months period only, because you are expected to receive the currency in 4 months time. So you just want to actually hedge for a 4 month period. So how much does it turn out to be? 6.3724 million. Okay, just wait. I'm gonna explain to you the principle behind this. Basically, what happens is when we talk about the money market hedge, what happens in a money market hedge is you borrow in one currency and you deposit in another currency. Now you need to decide, because you see the money market is actually operating with two of the currencies, with one currency being borrowed and the other currency being deposited. So if you have foreign currency receipt, then you need to create a foreign currency loan. Why? You will get an answer to it in a while as soon as I actually do it. So basically the foreign currency receipts, you have a USD receipt, so we would create a USD loan. Now question mark that arises is what should be the loan amount? So as I said, that the loan amount should be such that the loan plus interest on this should equal the receipt. The loan plus interest on this should actually equal the receipt. So I'm being told that the loan, which is the USD loan, is subject to a rate of 3.7% per annum. So if I actually have to obtain the USD loan for a period of 4 months, then the total interest that I shall be paying is going to be for a period of 4 months only. So my amount is going to be 6.45 into 1 plus 3.7% power 4 upon 12. So yes, it is going to be less than the amount that you are expected to be received. This is 6.3724. So we have actually borrowed the loan of 6.3724. Now what are we going to do? We are going to convert this USD loan to local currency. We are going to convert this USD loan to local currency, which is the CHF. Now, how exactly are you going to convert this into the USD, into this local currency? So you are going to say that this 6.3724 million, and it is actually going to be divided by the exchange rate. Now, what is actually going to be the exchange rate? So we need to see that what is the spot exchange rate. Are we being given the spot exchange rate? Okay, if you look at this part of the question, so you are being given the spot exchange rate here. You're being given the spot exchange rate here, which is 1.196 is to 1.1222. So what we are actually going to do is that we're going to say 1.122. So resultingly, how much is going to be the CHF that we are going to receive? Can somebody please confirm? Okay, so this is actually going to be 5.683424 million. So what is going to happen is the first step was that we borrowed the USD. The second step was we converted this USD into CHF, which is our local currency. The third step is going to be we are going to deposit the CHF at a rate of what? What is the rate which is available? So the rate, the investing rate for the CHF is actually this 2.7%. So we are going to deposit it at 2.7%. So if I am actually going to deposit it at 2.7%, then what am I actually going to get? So you need to do is that you need to perform the calculations for it. Now this is actually going to be 5.683424. This is what you need to deposit at 2.7%. Now all these actions, which is step number 1, step number 2, and step number 3, all of these actions actually take place now. All of these actions take place now. Now, so this is what we are doing. All of this is going to happen now. Now, what is going to happen 4 months later? What is going to happen 4 months later? When you are going to be standing 4 months later, then the things that are actually going to happen is the CHF amount that you have deposited. The CHF amount that you have deposited, it is actually going to be withdrawn, and the foreign currency receipt, which is actually the USD receipt, would be used to repay the foreign currency loan, would be used to repay the USD loan. Now, what exactly do I mean by this? Now, what is actually going to happen is we have deposited the CHF. How much is the CHF that we have deposited? 5.683424. So this 5.683424 is actually being invested at a rate of 1.027 at 2.7 power 4 upon 12. So resultingly, the amount that we are going to get is going to be this amount. And the loan that we are actually going to repay is we borrowed a loan of 6.3724. So we borrowed 6.3724. The interest of 3.7 is going to arise on it for a period of 4 upon 12. So this is actually going to become 6.45. So whatever the receipts are going to be there, those receipts are going to be used to repay this loan plus the interest. and we are going to withdraw the amount that we had deposited. So how much is it all going to be? Can somebody please confirm? So 5.734. 5.734 is the amount that we are going to get. Now, whenever we are hedging ourselves for the currency, what we do is that we say that as a result of the hedge, what is the end result that we have got? What we do is that we always try to identify the end result of the hedge. Now, so what is the end result that we have got? We need to establish that. So if I'm actually going to talk about the end result for this, so let's actually try to understand. You have been able to get 5.734 million CHF. So this is actually going to turn out to be USD 6.45 divided by CHF 5.734. So how much are we going to get? So it's going to be 1.1248. 1.1248 is the rate that we are actually going to achieve. Now, so what I'm actually going to do is that I'm going to summarize what I did discuss for the whole of it. The first thing that I actually went through was I first of all established that what is the total net amount. We were expected to receive 10.15 million. We were expected to pay 3.7, so the net result turned out to be 6.45. So I established that the net receipt is going to be 6.45 million. Now what next is there? I said that whenever you are expected to receive the foreign currency, then the way to deal with it is the foreign currency should be used to repay the foreign currency loan. The foreign currency receipt should be used to repay the foreign currency loan. So what did we do? We actually we decided that we are now going to borrow USD. So we need to borrow the USD such that the amount of loan and amount of principal interest should equal the total receipt. So we borrowed this 6.45 multiplied by, we discounted them using 3.7 rate. So we ended up getting 6.3724. Now, so 6.3724 is the amount of loan that we got. Then what we did was we converted this USD receipt into the Swiss francs, and we deposited the Swiss francs at the deposit rate of 2.7%. And what we did was we waited for the period of 4 months. After 4 months, when we got the receipt from our supplier, so we used that receipt to repay the bank. The receipt amount and the loan plus interest amount for the bank were equal, so we repaid the entire receipt. And then what we did was we withdrew whatever amount of Swiss francs that we had deposited. So we ended up getting 5.734. Now, so what I did was I calculated the exchange rate that we have got. So the exchange rate is 6.45 million USD was converted into 5.734 was converted into 5.734 Swiss francs. Resultingly, this is what we actually got. Is it okay to everybody? Okay, is everyone fine with it? Okay, now let's move forward and Which part, Kofi, which part? Okay, anyways, there are few students who are having this problem that I did not explain the concept. So my regrets for that. I actually had a focus that it is going to be a question-based revision session. So I thought that a lot of students would be prepared for these, and that we will use this session for the exam practice only. But anyways, I'm actually going to explain the short concept also, so that you can have a better idea that what exactly are we doing and why exactly are we doing. So let's just wait. I'm the next thing that I'm going to do. I'm going to explain the things now. Um, so we had this. Okay, I'm actually going to discuss the concept. No worries, I'm going to discuss the concept also, because we had a specific instruction from the ACCA to actually go for the question-based revision only. Anyways, there is actually a question, which is that why did you divide? Now I'm going to actually explain to you that how to deal with currency conversion. I'm going to explain to you that how to deal with currency conversion. Let's just try to understand. You are a company which is based in Switzerland, and the exchange rate that is actually quoted to you is the USD per CHF. The exchange rate that you need, that you are being quoted, is the USD per CHF. Now, for example, if your receipts or payments, if your receipts or payments are in USD, so what you want is you want to convert these receipts or payments into CHF actually. I'm going to repeat actually. Your receipts of payment are in USD, so you want to convert this into the CHF, which is actually your local currency. Now, at times the students, they get confused that whether we need to divide the rate or we need to multiply the rate. So I'm going to explain this concept. Now, remember, you need to try and ensure that you cancel out the common currency. For example, this is USD upon CHF. So if I multiply it with the USD, I am not able to cancel out the currency USD. The exchange rate that I'm being given is the USD upon CHF. If I multiply, I'm not able to cancel out the common currency, which is the USD. Now what happens is that if I if I actually divide the USD receipt with this exchange rate of USD upon CHF, so resultingly what happens is, if we solve this, the next step becomes USD multiplied by CHF upon USD. So resultingly what happens is the USD gets cancelled out and you get the cash flow in terms of CHF. So whenever you want to deal with the currency conversion, always see that how the exchange rate is quoted, and you need to cancel out the common currency. I hope that this is clear to everybody now, that how do we cancel out the common currency and why do we divide and why do we multiply. Okay, and now the next concept is, where do we use lower rate and where do we use higher rate. So first of all, let's just try to understand that what is the main concept behind the exchange rate. Now, what is the main concept behind the exchange rate? Remember, in this specific scenario, the exchange rates that are being available, that we are being made available to, is this 1.196 is to 1.1222. Now, I am actually going to demonstrate this to you people. We are expected to have a USD receipt. We are expected to have a USD receipt. The exchange rate quoted is USD upon CHF, and the rates that we have is 1.1196 to 1.1322. Now, let's say if I say that the receipt are going to be USD 7 million, 7,000. So if I divide this USD 7,000 with 1196, if I divide this USD 7,000 with 1.1222, the amount of CHF that I get in both of the scenarios are actually going to be like this. 7,000 divided by 1.1196 gives you approximately 6256. And if we say that 7,000 divided by 1.1222, then what we get is we get 6237. Now let's just try to understand that when you are actually going to the bank, and you are saying that I want to sell my foreign currency, the bank would not want to pay you higher amount. The bank would not want to pay you higher amount. Why? The bank would say that in one of the scenario we need to pay you 6252, and in the other scenario we need to pay you 6237. So we're not going to pay this amount, we're going to pay this amount. So remember, whenever you are expected to receive the currency, foreign currency, the conversion rate is going to be such which leads to the lower receipt. The conversion rate is going to be the one which is going to be lower receipt. And whenever you are expected to, whenever you are expected to make a payment, the exchange rate is going to be the one which leads to higher payment. The exchange rate is going to be the one which leads to higher payment. So that's what you have to remember. So I can help you people understand this thing, and you can actually rote learn this specific scenario also, which is when you have got a receipt and when you have a payment. If the exchange rate is dividing or if the exchange rate is multiplying, then how do you actually need to go about? So that if the exchange rate is dividing, for the receipt you need to take the higher rate, and for the payment you need to take the lower rate. And it's going to be other way around. You need to take lower rate here and you need to take higher rate here. So for all of you who always struggle with these exchange rate, here is some of the situation for you people. You can remember this. I have explained to you that when do we divide. I've explained to you when do we multiply. If you are okay with this, when do we multiply, when do we divide, then you can easily opt for the relevant exchange rate. Okay, now let's move forward. So we have gone through the money market hedge portion of the question. And now I'm actually going to move forward and I'm going to talk about the currency futures. So now I'm going to discuss that how do we go about with the currency futures. Yes, Karan, you can get the copy of these writings. So if I talk about the currency futures, now let's talk. First of all, there are few steps which you need to follow for the currency futures. And what are those steps? Let's just try to understand. You need to decide which contract. Number 2 point is that the number of contracts. The third thing is the hedge strategy. The fourth thing is determining the gain slash loss on futures. Number 5 is establishing net exchange rate. So establishing net exchange rate, these are few steps. Okay, so for those of you who are not aware about what exactly are currency futures, so the currency futures are actually your exchange traded currency contracts. They are exchange traded forward contracts of currency. So what exactly are these currency futures? These currency futures are the exchange traded currency contracts. And when we talk about these various steps, that how do we actually go about hedging the currency futures? So you need to understand that the futures, as they are exchange traded, so they are of a standardized contract. That means uh, the standardized contract in this sense that the future contract are standardized with respect to the currency for which the future contracts are available. They're standardized with respect to the amount for which the contracts are available, and at the same time, um, at the same time, the dates for which the future contracts are available. All of these things are usually standardized. All of these things are standardized. Now let's just try to understand. The forward contracts are not tradable. Future contracts are traded contracts. Now, so usually what happens is, um, in the exam scenario, you would be given the currency futures with various maturities. Like it could be March maturity, it could be June maturity, it could be September maturity, etc., etc. So you could be given the currency future with the various maturities. So when we say that which future contract should we actually opt for, so which future contract should we opt for? So always remember the contract whose maturity is immediately after receipt or payment date. Receipt/payment date. So always remember the contract whose maturity is after the receipt or the payment date. You will always opt for those contracts. So if I talk about this specific scenario, we are being given the exchange traded future contract. It says that CHF 125,000, price quotation USD per CHF. So it says the contracts are for Swiss francs 125,000, and the price quotation for each contract is given as this USD per Swiss franc. We have been given the contracts which have a 3-month expiry, I mean, which mature 3 months from now, and we have a contract which matures 6 months from now. So as I mentioned, we always opt for the contract with maturities immediately after our receipt or the payment date. So if I talk about it, now is the date today. We are expected to receive the money in 4 months' time. The contracts that are available to us have a 3-month expiry, have a 6-month expiry. So which contracts are we actually going to use? The contract that we are going to use is going to be the 6-month contract. Why? Because we always need to use the contract whose maturity is immediately after the borrowing, immediately after this receipt or payment date. So the contract that we need to use are the ones whose maturity is after the receipt or the payment date. So if I say that the various steps for the currency futures, number one of them is which contract to go for. So you would go for the contracts which have a 6-month expiry. You'd go for the contract which have a 6-month expiry. Is it okay to everybody? Is it okay to everybody? Okay, now let's move forward. So the next step for the futures contract is the number of contracts. The next step is the number of contracts. Now, generally speaking, how do we establish the number of contracts? So we say the receipt or the payment amount, and this receipt or payment amount is divided by the contract size. Now, over here, the problem that we have is our receipt is USD 6450,000, and the contracts are actually in 125,000 Swiss francs. So if our receipt is USD 6.45 million and the contract is in CHF 125,000, then we cannot actually divide these. So what do we need to do? So we need to actually go an extra mile. We need to first of all convert this USD into CHF, and then we need to divide it with this CHF 125,000, so we end up getting the number of contracts. Now the question mark that happens is how do we convert this USD 6.45 million into the CHF? So you can opt for multiple things. You can opt for the spot rate, you can opt for the forward rate which is available, or you can opt for the price of relevant future contract. You can opt for the price of relevant future contract. You can opt for either of them. So what I'm actually going to do in this situation is I'm going to say 6.45 million. I'm going to divide this with the rate for the 6-month currency future. So the rate that I'm being given is 1.1204. So I'm going to use this 1.1204. So that means this is actually going to convert into the CHF, and then I'm going to divide it with CHF 125,000. So if we talk about it, so resultingly, the number of contracts that we get is 46 point something. Okay, it's actually going to be 46.03 contracts. Now, remember one thing, that the exchange, the futures exchange on which your contracts are actually trading, they don't allow you to buy a fraction of a contract. They don't actually allow you to buy a fraction of a contract. Instead, what happens is their insistence is that you should actually always buy these or enter into a whole number of contracts. Now, what do we mean by this? This actually means that you can opt for 46 or you can opt for 47, but you can't opt for 46.03 contracts. So resultingly, what we would do is that we would opt for the 46 contracts. Now, so resultingly, which contracts? It was a 6-month. How many number of contracts? 46 contracts. Somebody is asking that why are you saying that we can use different rates? The reason behind that is it's financial management. It is not financial reporting. It is you who is creating the hedge. It is you who want to actually have a approximate of the exchange rate that would be applicable. So what you could do is that you could use an exchange rate of your own. So any exchange rate would do would be okay, because we are just using the exchange rate for the sake of converting this amount into CHF so that we can establish the number of contracts that we need to enter into. Anyways, so we are done with 2 steps, which is which contracts. It was 6 months contracts. The number of contracts, it's 46 contract. The third thing is hedge strategy. Now, what exactly do you mean by hedge strategy? Now, remember, as I mentioned that these currency futures, we would come to the interest rate futures also at the future in the future period. So the currency futures, what they do is that when you actually buy a future contract, so that means you're entering into a contract to buy. You're entering into a contract to buy currency. Now, which currency? Obviously, in this specific case, it's actually CHF. Why? Because the contracts are mentioned in CHF. The contracts are mentioned in CHF. So when I say the future contract buy, so that means buy future contract means you are entering into a contract to buy a currency. If we say sell future contracts, if we say sell future contracts, so selling future contracts actually means that you are entering into a contract to sell CHF. So now let's just try to understand. When we go for these future contracts, a future contract is nothing. It's just a commitment with the exchange that you are going to buy the currency or you're going to sell the currency. So remember, if you have entered into a commitment to buy the currency, so what you would do is that at a later date, you are actually going to enter into another commitment, which is going to be an opposite commitment, and that would be to sell the currency. So what would happen is that your exposure at the exchange is going to close. Remember, whenever you are trading with the exchange, so what you do is that whatever the first action that you take, you have an open position on the exchange. You have an open position on the exchange. So that means if you buy, so that means let's say okay, if we buy the currency future contracts, that means we have a position which is open. And that means we have entered into a commitment to buy the currency. And at a later date, what happens is the exchange does not give you currency. The exchange does not receive currency from you. All that the exchange does is that exchange simply operates and exchange simply calculates your net gain or net loss. So when we are actually going to go for a later stage, what is going to happen is you need to close the position. And how would your position be closed? Your position would be closed using an opposite action. Your position would be closed using an opposite action. Now, what exactly do you mean by this? So basically, the hedge strategies for the futures are generally like this: buy now, sell later. What is now? What is later? For let's say in this case, now is today, later is going to be the 4 months period. The other type of hedge strategy could be sell now, buy later. So remember, the futures contract are the exchange traded forward contracts. Why do we enter into these future contracts? We enter into these future contracts because these future contracts hedges against the adverse movements in the currency. The exchange does not receive cash from us. The exchange does not pay cash to us against the currency. Instead, what happens is there is only a net settlement with the exchange that takes place. There is only a net settlement with the exchange that actually takes place. Now, what do we mean by this? So if you have a strategy buy now, sell later, this means you have entered into a commitment to buy a currency now, and at a later date, what you would have to do is that you would have to enter into an opposite commitment, which is to sell the currency in order to close your position. So it's always if you have bought now, then you'll sell later. If you have sold now, then you'll buy later. A lot of students, they ask a question: how can we sell the contract to the exchange when we don't have the contracts? Okay. Now, when you sell contracts, that means you have entered into a commitment to sell the currency. You have not sold anything. You have just simply entered into a contract to sell the currency. That's it. So if you have entered into a contract to sell the currency, at a later date, you will have to enter into an opposite contract, which is a contract to buy the currency to cancel out your position. So now, as I mentioned, the hedge strategy is going to be buy now, sell later, or sell now, buy later. Now, question mark that arises is when do we go for buy now, sell later? When do we go for sell now, buy later? For the time being, consider the current scenario. Consider the current scenario. Now, what do we want to do? In the current scenario, what do we actually want to do? We are expected to receive USD. So what we will do is that we will sell the USD. What we should be doing is that we should actually enter into a commitment to sell now and buy later. That means we should actually enter into a commitment to sell the US dollar in the future date. But now in this specific scenario, the problem that actually arises is, I'm repeating it again, in this specific scenario, the problem that actually arises is we cannot enter into a contract to sell USD. Why? Because the contracts are available in CHF only. The contracts are available in CHF only. See, the contracts are for CHF. So what do we need to do? If we don't have the USD contract, so let's try to put the requirement this way. If you are going to sell USD, then you are going to buy CHF. If you are going to sell USD, so you are actually going to buy CHF. That means what you would do is that your hedge strategy is going to be buy CHF, that is enter into a contract to buy CHF and sell later. So that is what you will do. You'll buy CHF, you'll enter into a contract, you'll say buy now, sell later. This is what your hedge strategy is going to be. Can everybody please confirm if you do get hold of how I have established this? So then I can actually move forward if you do understand this. Okay. Ali Hassan Dar, what did you not get? Can you please confirm? Okay. What about the rest of the people? Are you people okay? Okay, Nabil, just wait. The first thing that you people need to understand is that what exactly do we mean by buy future contract or sell future contract? This is something that you people need to understand first. So I said that when we say buy future contract, that means we are entering into a contract to buy currency. When we say buy future contract, that means we are entering into a contract to buy currency. If we say sell future, that means we are entering into a contract to sell the currency. Now, I mentioned that when you take your first action on the exchange, then your position becomes an open position on the exchange. And in order to close your position, you need to take an opposite action. So if you have entered into a contract to buy, then at a later date, you'll have to enter into a contract to sell. Is it okay till here? Now let's move forward. Next situation is, next situation is so the hedge strategy becomes buy now, sell later, or sell now, buy later, because either you will enter into a contract to buy right now or you will enter into a contract to sell. So if you enter into a contract to buy right now, you will have to enter into a contract to sell later. If you enter into a contract to sell now, you will have to enter into a contract to buy later. Is it okay? Okay, now let's move forward. So in the current scenario, let's try to understand the current scenario. What is your current scenario? Your current scenario is you are a Swiss based company and you are expected to receive USD. You are a Swiss company, you are expected to receive USD. Now, if you are expected to receive USD, so what would you do? What would you want to do? You would want to sell this USD because this USD is of no use for you. The reason behind that is you are a Swiss company. You need CHF. You don't need USD. So ideally, what we should do is that we should enter into a contract to sell the United States dollar. If we will enter into a contract to sell the USD now, so we'll enter into a contract to buy it later. But the problem that we have in the current scenario is that the contracts for the USD are not available. That means you can't go to the exchange and you can't ask them that please give me USD. You can't do that because the contracts are available for the CHF. You see, you can't do it with the exchange. Now, so what do you need to do? You need to understand that the contracts are for the CHF. So let's try to understand. When we are trying to sell the USD, that means those USD will give us CHF. That means you could other way around put this requirement as that we want to buy CHF at a later date. So that means we would enter into a commitment to buy the CHF. That means buy now and sell later. Do you get it now? Okay, Nabil, what is it that you're not getting? Basically, you see, you are a Swiss company. When you want to sell USD, so what would you get out of USD? You will get CHF. Okay, so that means if I say that we want to sell USD in the future, so this actually means that we want to buy CHF. Okay, you get it. Now, Tasneem, what do you want to know? So in the current scenario, our strategy is going to be buy now, sell later. So overall, the hedge that we have been able to create, is going to be what? Is going to be, you would say the third step, the hedge strategy is going to be buy 46 contracts now and sell later. Okay, there are still few students who are having issues that they are unable to understand that why do we buy now, why do we sell later. Now, remember, if you buy now, you're not buying any currency right now. If you buy now, you're not buying any currency right now. You're actually entering into a contract to buy CHF. So a contract to buy CHF means a contract to sell USD. You get it? Because the exchange contracts are quoted as USD per CHF. That means the exchange has mentioned that the CHF would be exchanged with the dollars. So if I say that buy now, means I'm entering into a contract to buy CHF, which other way around could be expressed as a contract to sell USD. And at a later date, as I mentioned, that you don't actually exchange the currency from the exchange. You simply, when you go to the exchange, you don't actually exchange the currency. You simply do a paper trading. You simply buy a paper, you sell this paper. That's it. The exchange closes it. Just wait for a while and you will get to know. So this is actually the third thing which has happened, which is the hedge strategy. Now, the next situation is determining the gain or loss on future, etc. Now let's just see that what exactly are we going to do. Okay, so now you have created the hedge, which is you have bought 46 CHF contracts now, and you will sell it 4 months later. So you bought 46 CHF contracts now and you will sell it 4 months later. Now, okay, now, so what does actually happen 4 months later? Remember, you would be USD 6.45 million receipt, and they would actually be sold at spot market. So I'm going to repeat again. As I mentioned, we don't actually exchange the currency with the exchange. In fact, we sell or we buy the currency at the spot market. So what is going to happen with this future? The USD 6.45 million receipt that you will get, you will sell them at the spot market. Now, question mark that arises is, are we being provided the spot exchange rate in 4 months time? The answer is no, we are not being given that, but we need to calculate that. How would we do it? Let's see. We are being given the spot rates, and we have been given the rates of 3 months, and we have been given the rate of 6 months. So what you could do is that you could estimate the forward rate. You could estimate the forward rate, which is from the 4 months from now. How would you estimate the forward rate? So you could just try to understand. The spot rate right now is 1.1222. The 6 month future contract is showing a rate of 1.1204. And we need to have the expected spot rate, which is going to be 4 months from now. So if you see, the exchange rate is declining over a period of time and declining and declining and declining and declining. So we need to establish by how much the exchange rate would have declined during this period. So what we could simply do is that we could say 1.1222 minus 1.1222 minus 1.1204 divided by 6 multiplied by 4. Why? Because this would have declined for the 4 months period. Resultingly, you could get the expected spot rate in 4 months time. Can somebody please calculate? I'm getting 1.1210. Is it okay? Okay. So 1.1210. Now, Pallavi Mittal, it says that mid rates are to be used for the netting question. It's not for this specific part. Okay, now what next is there? So basically what would happen is, actually in 4 months time, your receipt would be sold at 1.1210. So what are we going to get? We're going to get 5753, 5753791. We're going to get CHF 5753791. That's what we are gonna get. Okay, Obaidur Rahman, just try to understand that this exchange rate would reach this level in 6 months time. Now you need to see that this is a higher amount, this is lower amount. So that's why you need to deduct. It's not the premium or it's not the discount that's being given to you in the question. We are just extrapolating the exchange rate. Okay. So you see what is going to happen. What is actually going to happen is, okay, Ubaid Rahman, just try to understand. Your exchange rate right now is 1.1222. And the 6 month later, the exchange rate is expected to be 1.1204. We need to estimate on using these two rates that what would be the rate in 4 months time. So I'm saying that 1.1222 minus 1.1204 is the difference in the exchange rate, and this difference is going to reduce over a period of 6 months. And if I am trying to calculate this rate at 4 months time, so the reduction would have occurred for the 4 months out of the 6 months. So this 1.1222 minus this amount, you will end up getting the exchange rate here. Is it okay now? Okay, thank you. Now, so what have we got? We have got this actual in 4 months time. We have got this receipt at the spot market. Okay, now what is gonna happen? We need to calculate the gain slash loss on the currency future contract. So if you are going to calculate the gain slash loss on the currency future contract, how exactly are we going to calculate? Let's just try to understand. We actually bought the future, and the price at which we bought them was 1.1204. We now need to sell the future contract. Okay. So what is going to be the price of the future contract when we are actually going to sell them? So we need to estimate the price. How do we estimate the price? I'm going to take few steps. First of all, you calculate the basis. Basis is calculated now. How do we calculate? The basis is the difference between the spot rate and the future price. So the spot rate is 1,222. The future price is 1.1204. The difference between this is actually termed as basis. How much is the basis? 1.1222 minus 1.1204 gives you 0.0018 is the basis. So what's the basis? Basis is the difference between the spot rate and the future price. What would we do? We would actually say that then we need to calculate the remaining basis. Um, how would we calculate the remaining basis in 4 months? Let's just try to different. 1.1222 is the spot exchange rate. The future contract is trading at 1.1204. This 1.1204, the future contract, what is it indicating? This is indicating that the market is expecting. What is it indicating? It is indicating that the market is expecting the exchange rate to be 1.1204 in 6 months' time. So what we are saying is that the exchange rate is declining every month, and the total of 0.018 is going to decline over this time period. Total of 0.018 is going to decline over this point of time. So if I talk about 4 months later, so the difference between the spot rate and the future contract is going to be for the period of 2 months. So the remaining basis is going to be 0.0018 multiplied by 2 upon 6. That is the difference between the spot rate and the future is going to be only this 2 months difference. So the remaining basis is going to be 0.0006. 0.0006. Do you people get it? What have I done? Just see if you understand this concept. I said that how do we establish the price of the future contract 4 months later? So all that you need to do is that you need to use the spot rate. You need to compare it with the future price. So the difference between these two, you end up getting the basis. And then you need to establish the remaining basis. The remaining basis is for the period of 2 months. So it's 2 upon 6. And once you have the remaining basis, now you would use this remaining basis to estimate the price of the future contract. So how is the price for the future contract going to be established? So price for the future contract is going to be, this is 1.1204, which is expected to be the price at this date. So the price over here is going to be 1.1210. How you deduct the difference of 0.006? Deduct 0.006 into it, 0006. So basically what would happen is we are going to sell the future, which is 1.1210. Resultingly, what happens is we bought it at 1.1204. We are selling it at 1.1210, so we are selling it at a higher price. We bought it at this price, we are selling it at a higher price. How much is the difference? How much is the gain? 0.0006 is going to be the gain on the future. So we are going to do is that we are going to say 0.0006 is the gain on a future contract, and 0.0006 is actually a gain on the future contract. This gain is actually expressed in terms of USD. This gain is actually expressed in terms of USD because the exchange rate is quoted as USD upon CHF. So what would happen is this gain is going to be multiplied with the number of contracts, which is 46, and size of each contract is 125,000. So resultingly the gain that we will have is USD 3450. And what you would do is that you would convert this USD 3450 on that date's spot rate, which is also happens to be 1.210 because that's what we estimated. So this is actually going to be converted into this 1.210. So how much does it actually turn out to be? 2851. 2851. So this is actually the receipt, this is the gain, so this becomes the total receipt. Which becomes 5756642. Yes, contract size was in CHF. Okay, so I'm going to summarize whatever that we have discussed in this specific question, and then I'm actually going to move forward. So basically, I do understand that there is one or two calculations which the people are unable to understand. So I'm going to ask you a few things, just let me know, and I'm going to move forward with that. First of all, uh, everybody understands that which contract to go for and the number of contracts and even the hedge strategy now. Is that okay? Okay, now the next thing is all these three steps will be done now, which is to decide which contracts to go for, how many number of contracts to go for, and the third thing is that what should be the hedge strategy. Now what is actually going to happen is you will do all these things now and you'll wait for 4 months time. 4 months later, when you'll actually receive the money, what you would do is that you would sell it at the spot market. In this question, we were not given the spot rate, so we estimated it, but generally you would be provided with the spot rate. So you would sell this currency at the spot market. Is this okay till here also? Okay, now next. So once we sell it at the spot market and we get this amount of CHF, now what next is there? The future contract which we actually bought, the strategy was buy now, sell later. So we have already bought 46 future contracts. We now need to close those future contracts. So when we are actually going to close those future contracts, how would we close those future contracts? So that is something that needs to be understood. So in order to close those future contracts, you will have to actually sell those future contracts. You'll have to sell those future contracts. Now, what price would you sell those future contracts at? So you will have to estimate the price of the future contract at that date. How do we estimate it? Just leave it for the time being. Just leave it for the time being. So I said that what you do is that you would have to calculate the gain or loss on the future contract. Assume that you know that the price of the future contract at which you bought was 1.1204. The price at which you sold was 1.1210. Now, resultingly, what happens is this is the gain on the future contract that you have. So if we quantify this gain, this is a gain in terms of USD per CHF. We have got 46 contract and each contract is for 125,000 CHF. Resultingly, we end up getting a gain of 3450 USD. So basically the exchange is going to give you USD 3450 when on this specific date, because you see the contracts were priced in USD. It was USD per CHF. So the exchange is going to give you this 3450 and you would sell them at the spot rate prevalent on those markets. Now, I think everybody understands the methodology, the approach. There are few question marks, which is that how did you get the price of the future contract prevalent on that rate? How did you get this spot rate in the market at that date? And how did you get this spot rate in the market at that rate? So I think except for these three things, everybody understands that what is going on. Except for these three things, everybody understands what is going on. Is it okay? Okay, now, so for the question that what is actually going on, okay, just leave out this remaining basis, just leave out this remaining basis. Let's just assume that you are being given the price of the future contract. I'm going to explain this scenario in another question. Don't worry about this. I'm going to explain this in another question. Let's understand the methodology, and I'm going to explain this in another question, that how do we get the price of the future contract. But for the rest of it, are you people able to understand? Okay, great. We will have a short break. We shall take a break till we shall have a 10-minute break. Break till 10:45. I'm going to resume at 10:45. Okay, so welcome back. We have done one of the part of this specific question. So the first part was basically advise adverine company on and recommend an appropriate hedging strategy for the US dollar cash flow it is due to receive or pay to LTIT company. Now let's see. So resultingly, what are we gonna do? We have got two choices, and those two choices are when we go for this currency future, the net amount is 5756642. And when we go for the money market, the amount that we get in the money market is what? The total amount that we get in the money market is 5.734. So one of them is 5.734, and the other one of them is this one is 575. So basically, what happens is money market gives you 5.734. The future hedge gives you 5.756. So what are we going to do? And that is the futures contract end up giving us a greater amount as compared to the money market. Is that fine with everybody? Okay, great. Now let's move forward. The next requirement of the question is basically it says calculate the intergroup transfers which are forecast to take place and discuss the advantages of multilateral netting by a centralized treasury function within the adherence group. Now let's see. Let's actually discuss about the multilateral netting. I'm going to give a brief overview about what multilateral netting is all about, and then we shall discuss further. So when I talk about this multilateral netting, what exactly is the concept of netting? The concept of netting is to settle on a net basis. To settle on a net basis. So whenever we talk about the concept of netting, so the concept of netting is to settle on a net basis. Now, what do we mean by this? That how do we settle on a net basis? Let's discuss about this. There is a company, as we did discuss with this LTED company also, that Adverine company and LTED company. Adverine company, this LTED company had to receive. Adverine company had to actually, in fact, think from this LTED company. They have to receive 3.7 and they were supposed to make a payment of 10.15. So what we did was we said that they are actually going to settle on a net basis, which is that it is going to give 6.45 and that's it. So whenever we talk about the concept of netting, netting actually means to settle on a net basis. So the netting are actually of two types. And what are those two types of netting contracts? The two types of netting contracts are bilateral netting and they are multilateral netting. The two types of netting contracts are bilateral netting and they are multilateral netting. Now, what exactly do you mean by bilateral or multilateral netting? Bilateral is between two parties and multilateral is between multiple companies. Multilateral is actually between multiple companies. So I'm going to discuss how does the multilateral netting operates. So the key steps for this multilateral netting, I'm going to discuss those key steps for the multilateral netting. The key steps for the multilateral netting is number one, identify settlement currency. What do we need to do? We need to identify the settlement currency. And once we have identified the settlement currency, the next thing that we need to do is that we need to convert all the transaction into settlement currency. We need to convert all transactions into settlement currency. The third thing that we actually need to do is that once we convert all the transactions into settlement currency, we establish the net receipt slash net payment is established. Net receipt slash net payment is established. So I'm going to repeat it again. First of all, what do we do? Multilateral netting is when multiple companies, they agree that they are going to settle on a net basis. So how do we go about it? It's actually, first of all, you need to identify the settlement currency. Once you have identified the settlement currency, then what you do is that you convert all the transactions into settlement currency. And once all the transactions are converted into settlement currency, then what happens is a net receipt or the net payment is established. So what is going to happen in this specific scenario? We are being told initially is that balances owing between parent and its subsidiaries are settled by multilateral netting. Uh, and the parent is based in Switzerland. Let's see. It says the balances owed to and owed by. The balances owed to and owed by are being given that this is owed by this one, the owed to is this company, and then the amounts in which these balances are owed to and owed by. It says the spot rates are currently these, and it says the group members will make settlement in the Swiss francs. So the settlement currency is Swiss franc in this specific case. The spot mid rates will be used in the calculations. Settlement will be made in order to the company owing the largest net amount in Swiss francs will settle first with the company owed the smallest net amount. So the steps that we need to adopt in order to attempt this specific part of the question is that first of all, we need to calculate the spot mid rates. Now, how would we calculate the spot mid rates? Let's see. So the mid rate is calculated as one of the rate is the currency buying rate and the other one of them is called the currency selling rate. One of the rate is the currency buying rate, the other rate is the currency selling rate. The mid rate is basically you add up the buying rate, you add up the selling rate, and then you divide them by 2, so you end up getting the midpoint. So if I talk about the midpoint for this, and the midpoint for this, so let's just try to calculate the midpoints for all these three. Can somebody please confirm? Okay, how about the other one? Now the next step that you need to do is that you need to convert all of these transactions. You need to convert all of these transactions into, you need to convert all these transactions into CHF. So these transactions need to be converted into CHF. The exchange rates that are given to us are basically this euro upon CHF, USD upon CHF, BRL upon CHF. So what you actually need to do is that you need to divide them by the exchange rate. You need to divide them by exchange rate. So this would remain CHF 5.9, sorry, 15.9. This would remain 4.46. You would divide this by 0.9358. You'll divide this by again 0.9358. You'll divide this USD by 1.1209. divide by 1.1209, and then you divide this one by 3.1569, and then you divide by 3.1569. So can somebody please tell the values? Um Nasir, mid rates are because that's what the examiner says, that you need to use the mid rates. Okay, so the values that we have got is one of them is 26.59. The other one of them is 19.84. The third one of them is 26 point, in fact, 24.16, 5.07, 12.29, and 16.22. Okay. Okay, so we have got the values. Now, now what you need to do is that, first of all, the first step was that we calculated the mid rate. We knew that the settlement currency is going to be Swiss franc, it was mentioned. Then what we did was we converted all of them into the Swiss francs. Once we have converted all of them into the Swiss francs, then what we need to do is that we need to establish a transaction matrix. What do we need to do? We need to establish a transaction matrix. How would you establish the transaction matrix? You would say we have got Adverine, which is the Swiss company. Then we have got Boscha. Then we have got Colgate. And then we have got Dilling. So you've got Adverine, Boscha, Colgate, Dilling, and then this is going to be a total, and this is also going to be a total. Now what you could do is that you could actually read them both ways. You could say that we are reading them as owed by, and we're reading downwards as owed to. So first of all, the first transaction, as it says, owed by Adverine. Adverine owes it to Boscha, which is 15.9. Adverine owes it to Boscha 15.9. Then Adverine owes to Dilling is actually going to be 4.46. Then Boscha owes to Colgate. So when Boscha owes to Colgate, the amount we calculated was 26.6. Then we have got Boscha owing to Dilling, and the amount is going to be 19.84. Then you have got Colgate, which is owing to Adverine. The Colgate, which is actually owing to Adverine, the amount was 24.16. And then you have got Colgate owing to Dilling. The amount is 5.07. And then you have got Dilling Company, which has to pay to Bosha, which has to pay to Adverine. And how much is it actually going to be? It was 12.29. And then Dilling Company owing to Bosha, it was 16.22. Now what you actually need to do is that we read the owed by as across and we read the owed to as downwards. So the owed to was read downwards, owed by was read across. What we are actually going to do is that we're going to add up all of them. We're going to add up all of them this way, and then add up all of them this way. So can somebody please share the total of these rows? Okay, and what else? About the third one, Colgate. Okay, and what else? So we have got 28.51. Now, what you need to do is that you need to calculate the values this way also. You need to calculate the values, the totals for the column also. Okay, what else? So we have got these various. So this is total owed to, and what we would do is that we would place the total owed by them over here against this. So when you would actually plot this total owed by, so 20.36, then 46.44, then 29.23, and then you have 28.51. So you will actually end up getting net receivable or net payable. You'll end up getting net receivable slash net payable. Let's try to figure out that how much is the net amount. Okay, so the net amounts that we have is 16.09, negative 14.32, then 2.63, and then you have got 0.86. Okay, so resultingly, we have got net receivable or net payable. So if you see that this company, which is the Bosha company, the highest debt is actually for this Bosha company. Then you have got Colgate company and the maximum amount that is received by Adverine company and then by Dialing company. So we were actually being told that how would the settlement be? It says settlement will be made in the order that the company owing the largest net amount in Swiss francs will first settle with the company owed the smallest net amount in the Swiss francs. So what is going to happen is, first of all, this company Bosha would pay to Dilling, and then Bosha would pay to Adverine. And then later on, what would happen is Colgate company would pay to Adverine. So this is how the settlement would take place, because the company owing the largest amount is going to make the payment to the company who is owed the lowest amount, and then the sequence would go on and on. Is this okay? Is everyone okay with this? Now, okay, Nabil, what's wrong? Ali Sandar, are you okay? Okay, sequence of payment. It says the company which has got the largest amount of debt would first make payment to the company which has got the smallest amount of receipt. So the company Bosha has got the largest amount of debt. Who has got the smallest amount of receipt? It's a company called this Dilling company. It has got the smallest amount of receipt. So first of all, Bosha would make payment to Dilling, and then once the Bosha has settled Dilling, then they would make payment to Adverine. Then once Bosha has settled its account, then the net payment is actually going to be made by this company. The name of this company is basically Colgate company. It would make payment at a later stage. Okay. Yasmin, the sequences, uh, it says that the company which has to make the highest payment is gonna settle first to the company which is due to receive the lowest amount. So the Dilling company was supposed to receive the shortest amount. That's why Bosha company is gonna make payment to it first and then later on. Yes, Colgate. No, the lowest receipt is not for Colgate. Lowest receipt is for Dilling. Colgate has got a lowest payment. This is net payable. This is payable. Yes, on the net basis. Anyways, so lastly, we have got the third requirement of the question, and which is basically, in fact, this requirement which says advantages of multilateral netting by a centralized treasury function. So I would actually explain to you briefly some of the advantages of this multilateral netting. One of the advantages of this multilateral netting is that the transaction costs are saved. The number of transactions they reduce. If you look at this, a total of 1, 2, 3, 4, 5, 6, 7, 8 transactions would have taken place. But over here, only 3 transactions would take place. What are going to be those 3 transactions? Bosha would make payment to Dilling, Bosha would make payment to Edverine, and Colgate would make payment to Edverine. So what happens is the advantage that you get with respect to it is that the transaction costs are saved because the number of transactions they reduce. The second thing is that the number of currencies to hedge reduce, and the currency spread costs are avoided. Why? Because when you actually don't have to hedge every single currency, so that means the overall the currency net exposure is avoided. And lastly, the net exposure is hedged instead of the gross exposure. So overall, remember one thing: whenever you reduce the amount of the money that you need to hedge, resultingly the overall cost of the spread is also going to reduce, because the bank, it charges its money. The bank charges you for whatever the difference in the buying and the selling rate. That's the bank's commission. So bank's charges, you have to pay this cost. So you end up saving this cost if you go for the multilateral. So I hope that this is okay, and everybody okay with this. Okay, so my what I would want you people to do is that we shall keep the today's session till here, but the ACCA team would like to have the feedback on today's session, and I would also appreciate if you people could share your feedback for today's session, so that we could actually improve for the next session. Uh, Thank you, Muhammad Sheikh. Thank you, Ubaidur Rahman. Thank you, Nabil. Uh, Basically, thank you, Karan. Thank you, Minzaul Haq. Thank you, Tasneem. Tomorrow we'll continue with the currency. We have few things to be sorted out on the currencies. Yes, we will continue with currency hedge, and we will continue with the currency. Thank you, everybody. Thank you, Mary Claire. Thank you, Kushal. Thank you, Pulavi Metal. Thank you, Shelly Davy. Yes, I will. And the WhatsApp group link has been shared to you people. All of you could join the WhatsApp group. And Aaron, the lectures would be uploaded on the Vimeo website. Okay, thank you, everybody. Thank you so much for your feedback. Fawad Hassan, if you have registered for this webinar, which you have obviously, so you will get an email with the link. Ubaid Rahman, don't worry about it. I would go for a detailed question tomorrow. Don't worry about this. Okay, thank you everybody. Thank you. See you people tomorrow, inshallah, with more and more learning. Thank you very much.